Hello, everyone, and welcome. My name is Nicole McLaughlin, and I am the marketing specialist at CaseWare RCM and today's moderator. I hope you're doing well, and thank you for joining us. We have an exciting presentation today on high-risk customers. I am so excited to have Sarah Beth with us today. Sarah Beth is the founder of Palmera Consulting, a specialized AML CTF advisory firm, providing AML system validations, remediations, SME roles, product rollout, and risk assessments. She brings 18 years of anti-financial crime experience, 14 of those CAM certified, working with financial institutions of all types, including banks, credit unions, FinTechs, trade finance institutions, MSBs, broker-dealers, and mortgage companies. She is recognized in the compliance industry for her ability to navigate and operationalize global AML, CTF regulations, and as former AML officer, she provides actionable, sustainable, and effective solutions through firsthand knowledge of our systems and data impact how data impacts daily compliance efforts. We are so pleased to have Sarah Beth with us, and with that, I will hand the slides over.
Thank you so much. All right, so let's get right into it. I know the first time that, or a couple weeks ago when we did the first of this three-part series, that I kind of ran short on time. So I tried to make sure that I don't talk as much this time and leave more time for questions at the end. So this is just an overview of what we're going to look at today. A lot of what you'll see throughout the presentation today is the regulated versus the unregulated industries and how that directly impacts how you view your high-risk customers. But before we get too far, I want to just start with a poll. So I know this question is really wordy, but I will try to say it in less words in a person rather than trying to write it. So basically, if you can launch the poll, what I'd like to know is if your high-risk customer criteria, if that criteria that you have that's separate than the transaction monitoring side, do you typically have customers that are not previously known to you, or are they pretty much the same customers that you see on the monitoring side? Right? You see ABC convenience store, and they always pop on both the transaction monitoring side and also on the high-risk customer side. So I tried to give a few different options here. If we could just leave that up for a little bit.
Yeah, so we've launched the poll, and we're just waiting for the results to come in now.
Okay. So that's good. So there's a few, so it's kind of split between first and second option, at least right now, where we have some that state that they overlap between the two sides, and some that state that they're mainly the same names. So I would assume if we were to look at who is marking the second option, which is that there's some overlap but mainly new customers, those would be some of the larger banks. And I think later we can get into that, but for me, I would expect to see that some of the community-sized institutions would be marking the first option, that they're mainly the same names from the transaction monitoring alert side, or that they completely match almost every time. So we'll just give it a few more seconds here, and then we can close the poll, because I think this is I think this is always a good thing to look at. This is something that before every remediation I do, before every gap analysis project, this is one of my first questions, because this is a quick litmus test to see whether or not you have an effective customer due diligence program as a whole. Because the thing that we don't want is we don't want both sides to have the same type of results. Sorry, go ahead, Nicole.
Yeah, so I've ended the poll now, and I'm just taking a look at the results. So for the first answer, we have about 33%. For the second answer, having some overlap between the two sides, we have about 58 to 60%. And then for the final two, we have the lowest, which is 6% for completely matches almost every time, and then about 1% for completely different almost every time. Okay. So that's what you would expect?
Well, that's what I would expect from larger institutions. So if we would look at the ones that marked number 2, which is some overlap but mainly new customers, those usually come from bigger budgets, if you will, like all those institutions that are allowed to have some AI on top of their anti-money laundering system, because one of the signs of effectiveness is not having the same results, right? Like you want to get to your customers that are not previously known to you. And so this is a good test if you're looking, last webinar, we looked at some ways that you can quickly test to see how effective things are. And that's where this type of approach, when it comes to your customer due diligence side, very, very easy. Now, this is a 10,000 foot type of question, but it's a quick litmus test that says, hey, if you have the same customers that are alerting on the transaction monitoring side and almost the same customers on your high-risk customer criteria, there's got to be some give, because there's going to be a whole bunch of customers that you don't know about. So that's where your criteria on your high-risk customer side should not mimic what's going on in your transaction monitoring rules. And that's something I think a lot of smaller institutions really struggle with. And it's not a knowledge issue. It's usually a system ability issue, right? Their systems don't really allow them to build custom criteria based on the threats of the customer. And that's what we're going to go through throughout this presentation today.
Interesting. Yeah, I'm really excited to jump into things.
All right. Okay. So let's look here. So one of the things that I've been, this is kind of like my hill that I'm going to die on because I've been talking about it for about 8 years, about the contextual baseline, like the contextual awareness of your high-risk customers. And contextual data plays a big role in that, but how do you close that gap on knowing what contextual data is? So I think for me, trying to leverage what the FATF says really is kind of the baseline for everything we're going to go through today. So when you know who your high-risk customers are and when they're properly managed, it really gives you the proper baseline, the benchmark, if you will, by which you measure all other activity. And when I first started talking about this a while ago, it was kind of like, well, what do you mean? My high-risk customers are separate from my transaction monitoring side. And that's standard. I mean, even when we do build outs of AML teams, we still have them separated, but there should be referrals from your monitoring side that flow over to your high-risk customer side. And then there should be requests from your monitoring side to your high-risk customer side as well. And then a request from your high-risk customer management side to your transaction monitoring side. There should be some synthesis there between the two areas if they are separate. And that's really supported by this very old quote from the FATF, where in 2011, they stated, an absence of sufficient information due to too little customer due diligence could make monitoring meaningless. I mean, to me, you could not get more impactful than that. And it was just one of those statements throughout their plenary that they did in 2011. But to me, it packs quite a punch in terms of what the operational impact of that is. So you can have the best monitoring side in the world, but if you don't have enough information on that customer, if you don't have that contextual baseline, then your monitoring could be meaningless, which is pretty serious. And I know that we have global institutions on the webinar today, so it's not just US institutions, but for the US institutions and those who are foreign banks that do comply with FinCEN regulations, there's also a great quote from page 64, and that's from the 2014 version, the FinCEN exam, or the FFIEC BSA AML exam manual. And it says, upon identification of unusual activity, assigned personnel should review customer due diligence and other pertinent information to determine whether the activity is suspicious. And this statement is actually kind of buried, if you will, in the middle of the suspicious activity reporting chapter, but it really speaks volumes to what I think is the spirit of the regulation. And it again supports the earlier statement that I made that there should be some type of information sharing between the two areas. And if you're looking at your two areas, you're looking at the transaction monitoring side, you're looking at the high risk customer management side, and they aren't actively referring or actively asking questions, that's another great quick litmus test to see how much synthesis do we have here between the two areas. Are we really satisfying the spirit of the law according to what the FATF guidance states and what FinCEN states? All right. So now that we've established that, I want to get into what regulations have to do with it. It's kind of a nod to Tina Turner. But what do regulations have to do with it? And as you can see on this slide, we have a top line here that's more risk to the left, less risk to the right. And then on the bottom, unregulated to the left and regulated to the right. And then here throughout in the middle, you will see various industries or customer types, if you will. And this is something that I came up with for another webinar a while ago. And it really, I got so many comments on it because it gave you just that quick overview of what risks are inherent in your business, inherent in your customer types that could very well impact you if you are the bank or the credit union that have customers in these various buckets. So as you'll see, this is from the US. So if you're in the EU or in Australia or in Singapore, New Zealand, several other countries, if you're in any of those countries or similar countries to them, this will look confusing to you. You will most likely be thinking, that's not what it looks like. This is what it looks like in my country. And this is not, I'm not trying to make the US look bad. I am a patriot, but I think it's important, especially as we get into the transference of risk. It is important to know, and I'm just going to go back and forth between these two slides, what regulations are imposed on customer types, because that directly has an impact in what your institution is going to do and see, and what kind of systems that they should deploy, what number of employees that they should have. So I just am going to go back and forth here because I think it's good to see the differences here between the two. So this is the EU and Australia and a few other countries where you have a lot of these pawns, jewelers, accountants, travel companies, loan and finance companies, payment processors, et cetera. They're all regulated, so they pose less risk. It's not that just because lawyers in the EU are required to have an anti-money laundering program, it doesn't necessarily mean that, boom, there's no risk. It just means that they're less risky than in the US, where they have little to no, actually really no anti-money laundering regulations in the US. So if you are a bank or a credit union and you're banking an attorney or a law firm, and that attorney or law firm is based in the US, there's going to be extra risk there that you need to know how to handle. What do those threats look like if that law firm or that lawyer, it has zero anti-money laundering regs? And of course, if you're in the EU and you're banking an attorney, you can take some satisfaction, not all, but some satisfaction in the fact that they have their own anti-money laundering regulations, they have their own oversight body, and that directly is going to impact the risk that's then transferred to your bank or credit union. And so by that, I mean there's a transference of risk. And this is something, especially if you're a community institution under $5 billion in assets, even if you're a multi-state community institution, this is something really I think is a new idea, not necessarily for the AML practitioner, but for senior management and for the board. They don't really see risk or threats the way that you do, where you see risks and threats in various business types, like we just saw in the last two slides. And that directly impacts your rules that you have, whether the rules are on the high-risk customer criteria side or on the transaction monitoring side, but also is going to impact the type of employees and the number of employees that you have. So when you have this transference of risk from unregulated customers, you really should see some type of impact. And that impact really should come from an increase in fees. And I know there's probably some people cringing because I usually get that, oh no, I'll never get management to agree to increase fees for the certain customer type because the CEO or the chairman of the board, is best friends with the person who brings in most of our business from this one particular customer type. But I think when you can explain to them how the transference of risk works, and that because you now own the risk, because you're the only regulated party in the payment flow, now that you own the risk, you have to disclose it on your risk assessment, which means you have to do something with it. You can't just write about all of this risk that's transferred to you and then not do anything with it. You have to mitigate it at some level. You will have to just straight up avoid it or bring it in, which is fine, but you will have to have some type of mitigation, whether it's a better system, a different system, a second system, or more people to monitor. You should also see in the transference of risk that there should be an increase in the number of reviews that you're doing. So if you have, let's say, your business development or cash management team, they're out there and they're bringing in all these real estate type of businesses. They're bringing in title companies, they're bringing in title agents, attorneys. That is something that you should know about, one, and that should directly have an impact in the number of reviews and in the ongoing in the time frame by which you're performing these reviews. It should also help you limit the number of customers that are allowed in this riskier bucket. So going back to the real estate, you want to be able to say, hey, wait, if you're going to go bank every title company and every title agent in our footprint, I am going to need X amount of people because of the transference of risk, because especially in the US, title companies are not regulated. A lot of community banks love the fees that they get because it's a lot of money flowing through the banks. But there's no anti-money laundering regulations on title companies. And so that's a transference of risk to a lot of community institutions. So that's where you, as the anti-money laundering officer, you need to be able to state, hey, my team can only handle 5 title companies. You cannot go bring me 50. If you do, then I will need X amount of people. I will need a different system. And then you can quantify your needs. And then if management really wants to do it, then that kind of goes back up into the increase of fees. So you can eventually get them to agree to the increase in fees once you outline for them what the risks and threats are and what you will need in order to properly monitor them. So one of the other things that's very important is that it has to be accounted for in your risk assessment. A lot of times, and this is a terrible story, but it's a real story. And Southwest in the US, this was 2-ish years ago, and there was a $4 billion institution, and I was brought in to kind of redo their enterprise-wide risk assessment. And so I go in and I start with my high-level effectiveness questions, and they had this other firm that was doing the risk assessment for them. And when I read through it, I thought, man, something's not right here. And in the non-bank financial institution section, it stated that the bank did not have any money service businesses, so no MSBs in the US, those are money remitters, check cashers, things like that. it said they had no money service businesses, therefore they had no non-bank financial institutions. And money service businesses in the US are like a subcategory of a non-bank financial institution. And I thought, well, that's not right, because I had been through their data. And when I went in and I looked at the industry codes, I did some analysis, I did some cleanup, and they had over 1,300 non-bank financial institutions that they had historically never disclosed in the risk assessment, which means that they had no particular monitoring set on them. They were not properly staffed. They didn't have the right system. There was a lot of things that flowed out from that discovery. But 1,300 non-bank financial institutions is really what this bank had, and they had never looked at it like that, because they had they had an incorrect view of what a non-bank financial institution is. There are a lot of types. It's not just money service businesses. Money service businesses are actually regulated. If we were to go back to this slide here, do you see money service businesses over here in the US? They are regulated. Now, they aren't as regulated as, as much as banks and credit unions are. Well, the bigger MSBs are, but some of the smaller MSBs, but they still have some type of regulation. They still have to register with FinTech. They have to have an anti-money laundering program, et cetera. So the transference of risk was pretty low, where the rest of their non-bank financial institutions were really over here on the left-hand side and here in the middle. So very little to no regulation. So they had this massive amount of risk exposure. And it all came from not accounting for it in the risk assessment, because that was kind of their baseline for staffing needs and system requests and everything. So this is something where, especially for you, if you are a U.S. institution, I would really urge you to go through and make sure your industry codes are really correct, because that drives whether or not you know what your risks are, right? It all comes back to data. Having not just data in the field, but correct data in that field. So just go cast a wide net, see how many non-bank financial institutions you have, and make sure that they're accounted for in your risk assessment, because then out of that you can do the things that are listed above here. You can up the fees, you can limit the number of customers that are allowed to come in based on what your tolerance is of staffing and systems. So I just kind of wanted to go over some normal or known high-risk customer types. These are things, when you're talking to AML operational folks, it's like, yeah, I definitely know who my money remitters are. I know which ones are my cannabis companies. I know how many PEPs I have. I know my PATMOs, my private ATM owners. I know the ones that are payday lenders. And then it kind of, as we move towards the middle where the boxes are, and then to the right side, it gets a little, the wheels kind of come off the canoe, if you will. They tend to not know so much. And sometimes it comes down to data. But a lot of it, again, is not knowledge base. It's not that when I talk to AML folks that they're like, oh, I don't know what a service provider is. I don't know what a cash intensive business is. They're fully aware of that. It usually comes down to time and data. And if you don't have the right data, then you need time to fix the data. And that's something that a lot of AML officers don't really have the luxury of time. So I just want to make sure that we in this slide, that we close the gap, right? That we are able to get rid of this right-hand side where it says lesser managed high-risk customers. They should be not micromanaged, but they should be something that quickly, when an auditor or remediation person says, hey, how many investment firms do you have? It's not like, oh, I don't know. Because most times I can ask an AML officer, how many private ATM owners do you have? And they can provide a list. They go, boom, I have 12. Okay, great. How many payment processors do you have? How many EB-5 visas do you have? And I think especially the EB-5 visas, now that's a US thing, but it's equivalent to citizenship for pay, essentially. And a lot of countries have that. The US says that we don't have it, but we actually do, and it's in the form of EB-5 visas. And that's somebody who is a non-US person who can come here and invest, I believe it's $500,000, and them, and I think up to four people or 5 people, the regs changed, but 4 or 5 people can also come with them to the US if that EB-5 visa holder comes in and buys a failing US business. So I'm not saying that that shouldn't happen. I think it's a good thing, but I think knowing that that's what the purpose of an EB-5 visa is, that should have some type of data point, right? Your lender should be fully aware of what an EB-5 visa is. And most times, I would say 9.5 times out of 10, most community institutions, their lenders have never even heard of an EB-5 visa. So if you need more information on that, I wrote an article a long time ago about that, and I can send it to you after this. You can send Nicole an email and she can forward it to me. But these middle boxes here are more of the high level buckets, if you will, of higher risk customers. And you know, the non-bank financial institutions, kind of like what I just talked about, most people think that they're the money remitters or the MSBs or the check cashers. But they're also pawn stores and jewelers and title companies and real estate firms and securities firms. There's a whole bunch of different types that really don't get any attention. And that's where I would love to see just one big entire slide of everyone being fully aware of what higher risk customers look like. And I want to be clear on this, because usually when I talk in person to clients, they just kind of go into this, wait, so you're telling me I have to mark all of these as high risk? No. I am going to say it again. No. I am not saying that every pawn store, every FinTech, every investment firm, every church, every real estate firm automatically has to be high risk. No. But you should be able to quickly go through your data using industry codes and say, okay, I have 1,300 non-bank financial institutions. And under those non-bank financial institutions, 800 of them are securities firms, right? 200 are title companies, 150 are pawn stores. You should be able to break out that data so you can quickly see, okay, I have a lot of risk exposure in these security firms, in these securities types of firms. And because those are mainly unregulated in the US, that transference of risk is huge. And you really don't know how much risk you have until you start to apply the transactional volume, the source of the funds, et cetera, to that sub bucket, if you will, of securities firms under non-bank financial institutions. And this is something I know it sounds like a big task, a big lift, but it really is something, if you have the right data, really starting with the industry codes, this is something that you can do very quickly with pivot tables. I mean, I hate to go back to the start of analysis using Excel, but this is something, especially if you know how to do a pivot table, you can probably break this out using a pivot table in a matter of minutes if you have the right data. So I would encourage you, if you don't know if you have the right data, you should start there, making sure you have the right industry codes in that field. All right, so this is some sub buckets, if you will, of customer types. And this slide is just purely information. I'm not going to go through everything, but just as a reminder, this is where, when you have non-bank financial institutions, hard money lenders. I know a lot of community institutions have hard money lenders. Guess what? 0 anti-money laundering requirements in the United States. So where does that risk go? It gets transferred to the institutions that are banking these various businesses. And this is something where, U.S. institutions, you are not de facto regulators, right? There's nothing in writing that states that you are, the sole institution in charge of making sure that your FinTech or your securities firm is not doing something illicit. There's nothing in writing that says that. However, there is plenty in writing that states that you should know the risks of your customers and what they pose to you. So if you will if you are going to knowingly bank 800 securities firms, then you should have a pretty good handle on what they're doing and which ones are higher risk within that subcategory, that sub bucket. And you should be prepared to exit the ones that have a whole bunch of foreign wires coming in and out, and they aren't sharing any information, and you can't find any information about them online, and they look to be just kind of a securities firm based in the U.S., and all of their funds are coming in and out from overseas. You have sanctions risk there. You have anti-money laundering risk, and especially if you're looking at customers that are without anti-money laundering regulations, and that just blows up your risk, if you will. All right, so let's do, I think this is the second poll here. And
yes, I've launched the poll question here for you if you want to go ahead and read that, Sarah Beth.
Okay, so I just want to get a feel if your high-risk customer criteria, if it's tailored to the threats posed by the customer. So a lot of times people use the word risks. I think sometimes it can be interchangeable, but I like the word threats because when you're looking at customers, especially if you're in the anti-money laundering area, you should be viewing all customers as a threat. I know that sounds very harsh, but the anti-money laundering area in the institution is really the only part in the entire institution that should always think the worst about the customer, right? Because you owe that customer nothing. Your sole job is to protect your institution as much as you can from being used as a vehicle for illicit funds. And that's where I like to use the word threats when you're looking at customers. So this question here is your criteria tailored to the threats posed by the customer? So that would be, just an example, would be like a title company. You would have a criteria that looks at cash activity, right? Or foreign wire activity, as those are higher threats in the title company space.
Yeah, and while we're waiting for folks to answer that question, we had a question come in perhaps that you could address briefly. So the question is, how do we verify the intangible businesses such as marketing, media, affiliate marketing, things like that?
Okay, so they're asking like those business types.
Exactly. Yeah.
Okay. Yeah, that's a great question because I feel like there's a lot of those. I mean, I know as a business owner, I get a lot of those emails and LinkedIn and into my info email about I will help you grow your search results and blah blah blah. I think that's pretty difficult. I think for me it would depend on your country. I would start there. So if you are in the EU, they are highly regulated, and by they I mean not the marketing business themselves, but the various rails, if you will, the various rails that are used to conduct payment flows. So you have a payment processor, you have a payment company that sits behind that marketing firm, by which they get paid from people paying them for their marketing advice. So you have a couple different sets of eyes, if you will, on that whole payment flow. I think as far as it goes to trying to verify how much revenue is legitimate for a marketing company, to me, I always start with open source research. If I Google that marketing company or I search it on DuckDuckGo and I can't find anything on it, that's always a good sign for me that they probably can't justify as much revenue as I see coming in. Because if I can't find it, then how are other people going to find them in order to engage with them and pay them for their advice? And that kind of goes for any business, right? When you see any business that has any type of revenue, whether or not it's a service or a product, if you can't find them in the first 1 or 2 pages of Google, then how do other people, how do their customers find them? And I'm really good at finding things. And I would assume most AML officers can find anything. So if you really can't find this business, then how are other people finding them? And I think that's just kind of, I mean, that probably doesn't answer the question directly, but I mean, that's where I would start.
Yeah, so what I'm hearing you say is don't overcomplicate the matter. A simple Google search can actually provide a lot of insight.
Yep.
And then continue to investigate.
Yep.
Awesome. So let's take a look at the results. I'll end the survey now. So for number one, yes, criteria is customized for certain industry groups. We have about 50%, followed by no, criteria is categorized by business and individuals at 35%. And then yes, but only in the HRC reviews. Our trusted test is at about 12%. Does that make sense to you?
Yeah, that's good. So I would expect that those who answered number one were also the ones that answered number one on the first poll too, because the criteria to customize that for certain industry groups, it really comes down to your system. And the majority of systems in the community banking space, they don't really allow you to do that. Now, you can do it by peers and things like that in some of the systems, but I mean, if I could just say something about the CaseWare solution, that was something that I really liked when I rolled out your product with a couple of my clients, was that we could tailor the criteria to those customers specifically. And when we did that, we were able to take the customers out of all of the other analysis that went on for the high-risk customer criteria. So, where we would only apply the criteria to that group of title companies or to that group of payment processors. And we could tailor it down as far as we needed to go if the data was there. That's not a plug. I'm just saying I am a fan of your system for that type of usage or that use case. All right. So let's look at threats and vulnerabilities. So threats for me, again, different than risks. For me, you can't really get to your risks if you haven't looked at what your threats and your vulnerabilities are. So for title companies, these are quick things that should come to mind and really be the lens by which your team performs reviews on these various businesses. So if they're doing a review on a title company, you should see language throughout the review for regulated and depending on your country and your FIU requirements, if they are regulated or if they are unregulated. What kind of purchases, what the threats look like, because real estate can be used in the placement and layering phases. What the dollar amounts will look like. I mean, when you're dealing with a title company, you are going to see hundreds of millions of dollars throughout the year. Even in small institutions, you are going to see hundreds of millions of dollars for real estate. So you should be seeing a nod or some type of statement that addresses these various threats and vulnerabilities in the high-risk customer reviews. Also, the over and under of pricing. When you look at real estate, it's a great way to transfer value to somebody that you owe a debt to by under or overvaluing the property. There's also a veil of anonymity when you're dealing with title companies. On the wire or the checks that come in, they just have a name, and sometimes they'll have a property address. Well, if the property address is there, then there should be something being done with that. You can Google it. Google's your friend. Google it, see what it says on Zillow, on realtor.com, see what it says on Google Earth. How much did that house sell for? And is it normal given the neighborhood that it's in or the area? There's a lot of property record searches that you can do that are outside Google that are more formal at the county tax assessor site. Also for FinTech reviews, there should be some type of lens by which you view those threats. You obviously should address whether or not they are regulated or unregulated, but also you need to make sure that you're viewing your FinTech companies as higher risk because they're breaking up the payment flow. And that's something that the FATF says very clearly. in their money value transfer service, their MVTS is what the FATF calls these types of companies. And they clearly state one of the risk factors, and I take that to be a threat. One of the threats for fintechs, if you're banking a fintech, is the fact that they break up the payment flow. And if they are unregulated, if you are in the US, they're mainly unregulated, then that means that you get a whole bunch of risk that's transferred to you. So that should be addressed in those high-risk customer reviews. Lawyers are the same way. There's guidance from the FATF for professional money launderers and professional money laundering organizations, which is the PMLs and the PMLOs. There's a whole paper on that the FATF published. Lawyers, depending, again, which country you're in, regulated or unregulated, all of these points here, I'm not going to go through the rest of them for the sake of time, but all of these points here really should be addressed at some level, should be the lens by which reviews are done. So if you're picking up a high-risk customer review that one of your team members just did on a lender, and you don't see anything about sanctions risk, you don't see anything about knowing who the money is going to or where the money is coming from, if you don't see anything about how there's a veil of anonymity because you really only have John Doe on the wire out, those types of threats need to be accounted for in the high-risk customer reviews. Auto dealers are one of my favorites, especially in the US, because they are unregulated, other than the fact that they have to file a CTR if they deal in cash over 10, which most of them don't because there's no bite to the bark. They are required to do that, but there's nobody there checking in on them to make sure they're doing that. Auto dealers, great way to transfer value to somebody by overpricing or underpricing a car. All right, so I want to get into some effective high-risk customer reviews. So effectiveness, to me, it is kind of an elusive term. I know that the Wolfsburg came out in December of 19. They had their statement on effectiveness. And then August, I believe, of this year, they also came out and kind of, beefed it up a little bit and said, while we wait for the powers to be to define what effectiveness is, here are some things that you need to do. If you're a U.S. institution, we have the effectiveness advance notice of proposed rulemaking that came out, I believe, in September. And I have responded, well, I'm getting ready to finish my response to that, because as a former AML officer, I'm not hanging my hat on what their 2 or 3 sentence formal definition is going to be of effectiveness. Yes, that's good. And yes, I will do everything I can to meet that effectiveness defined that they're going to give us. But I want to know, what is it supposed to look like inside my institution? That's really, for me, they need to be operationalizing this. And so in my response to FinCEN regarding the effectiveness and PRM, I am giving them indicators of effectiveness. And they're really indicators of effectiveness by section, essentially. So these are the ones that I believe show very quickly if you have an effective high-risk customer management program. And the reviews specifically, this is what I'm outlining for you here. So this is something that you can check on your own very quickly. If you have never, or out of the 3 years or whatever you've been doing high-risk customer reviews and you've only filed 1 SAR, for me, that is the quickest sign that there are some signs of ineffectiveness. And it's not that you are ineffective. It's that, it may come down to the criteria. It may come down to your system, to some of your team members, and how they may not be seeing threats the way they need to see them. But one of the signs of effectiveness is filing SARs. If you are not getting SARs out of your high-risk customer reviews, then you need to rethink not only the customers that are coming up on your criteria, but also the way in which you are doing the reviews. Also, you need to be seeing a risk rating change. If you are just constantly seeing the same convenience store as high risk, and they're just always high risk every quarter you do it, and they're just high risk, something, there's got to be some missing information there in that high risk customer review. And that missing information will most likely fall into one of these indicators here. You need to reach out to other institutions. In the US, we have an information sharing portal called 314B, where you can reach out to another registered 314B institution and say, hey, you know, I see they keep getting checks deposited from your institution. Can you tell me the source of funds there? You also should be looking to exit the relationship. You know, you need to be looking at, do I need to increase my fees? Because this is my 20th high risk customer review I've done on this same customer, and it's taking up a whole bunch of time. You also should be using it to look at other similar customers, maybe ones that you don't know. Maybe go look and see, hey, how many other industry codes do we have that's exactly like this one guy that we've been doing a high risk customer reviews on? Do you need to put him on continuous monitoring? There's got to be some action that comes out of high risk customer reviews specifically. So for me, when I go in and I'm looking to rebuild when a bank has gotten dinged for their management of their customers, these are the high level litmus tests that I look at. And this is something, if you are over that area, these are things very quickly that you can go in and assess how effective your high risk customer management is. So I want to get to high risk customer reviews here. I know, and then I'll leave some time for questions. But these high risk customer reviews, this is a sample. I'd be happy to send you, I've got several samples of high risk customer review docs, and depending on what your preference is on what it looks like, I've got different Word documents that I always send out as samples. These are your starter pack, if you will, for how to do a high risk customer review properly. So this is one, it was on a convenience store, and these are all real live ones. Obviously names and addresses, et cetera, have been changed, but all these dollar amounts are real. And just so you know, I'm not standing up here, or not standing, but I'm not standing behind my laptop right now and saying that, this is how you need to do it. I actually do this. I have several clients that allow me to stay sharp on my skills, because I don't want to be up there going, you need to write this high risk customer review like this, and I've never done it myself. So this is actually one that I wrote. So, all right. So I want you to notice here, this is something, if you can see the ACH total, and then do you see how there's some sublines here? Merchant card, ATM, other gas, and lottery. This is something that most times not accounted for. Most community institutions just do the totals, the in and out of ACH and checks, but they don't break out the ACH. And it's very important to do that. One, because ACHs are the most used form of conducting activity for any customer, especially any business customer. So don't ignore the richness of the data in the ACH description field. You can easily break out what their merchant card deposits look like, what their ATM deposits look like, what their lottery looks like. All of that has rich data that can help you figure out exactly how much money, how much revenue are we talking about here in this convenience store. So if you aren't currently doing that, I would recommend you starting to break out the ACH totals, because that'll help you see the customer clearly. So this is just a summary. This is the first part of the summary. And as you can see here, there's a few things that I'm going to highlight, and these are things that I consistently see not addressed in high-risk customer reviews. For one, we need to know how many hours are they open? I mean, how will you be able to back in to their revenue to see whether or not it is remotely legitimate if you don't know how many hours they're open, how many days a week? if you don't know exactly what they're selling. They sell lottery tickets, they have beer and wine selection, they sell smokes, they have merchant card deposits, they have an ATM on site of which they're getting reimbursed through the ACH system, and they also have cash deposits. So when we outline all that, now there's only three small paragraphs here on the first page. It's not a whole bunch of words, but you're getting a lot out of it because of these statements that I've highlighted for you. Total income average, the monthly is $137,000. I mean, I own a business. I would love to have $140,000 in revenue a month. So that's quite steep given the fact that we broke out the gas deposits that they got back on that chart, and they aren't selling a lot of gas. They aren't selling a lot of lottery tickets. That average is only $26,000 a month. So as we go through the rest of the analysis, and this is the whole review here, there's, it is done in 2 pages, but there's some great detail here that I think helps you see the customer clearly and see whether or not something is off. And out of this, we ended up filing a SAR. But the first one that we did was we did a 314B, which are all of those signs of effectiveness that we talked about. So we have an average monthly income, 128. So when we took that and we put it against the hours and the days that we had on the first one, they had to sell $305 of products, chicken, snacks, beer, wine, smokes, every hour, every day. Every day that they're open, every single hour, they would have to sell $300 worth of stuff. That's a lot of activity. And of course, one of the great things about Google is that we could go see how busy this customer was. And they really weren't that busy. There were, days on Fridays after work where they would be, where we could see that they could tick up in their time or tick up in the number of people. But this is something, that once you get all of these numbers, you are able to figure out something's not right here. And out of that comes a 314B request to another institution because there was a blind part, right? There was a blind spot that we couldn't see everything. And then after we got the 314B request back, we were able to confirm our analysis of $305 of product every hour, every day that they're open. There's no way, given what we knew about the customer, given where they were located, there's no way that they could do that. So we filed a SAR based on all of the activity that we saw here. Yeah, and then fast forward, we ended up getting requests from federal law enforcement in the US, and there were drugs involved and a whole bunch of other things. So, but they probably wouldn't have known about it if we wouldn't have filed the SAR and done this high-risk customer review. So this is one of the things where you get 2. You get a 314B and a SAR out of this high-risk customer review. So the second example is a shorter one. This is about a PEP. This is a real life one. Again, names have been changed and the countries have been changed too. But this is something where, this is a different setup. This doesn't look exactly like the other one, but is just as effective. So I'm going to highlight some areas here. So he's the son. Depending on what your institution defines as a PEP, you may not see this person as necessarily a PEP, but that doesn't mean that they don't present risk to your institution. They still have access to their father's clout as a current politician. As you can see, there was an analysis here. It looks different than the last one. There's no special recipe for what it has to look like. It just has to produce something. So as we go through here, the dollar amounts aren't as exciting as the last one, right? We aren't talking about hundreds of thousands of dollars, but there's enough here to go, wait. There's too many things we cannot substantiate. So because we can't do it, we are going to put this person on the high risk list with quarterly monitoring. And then later, so this was early on, and then later this institution ended up filing a SAR on this individual because this type of activity continued to occur, where he would get large deposits, really no type of expenses that are going out. He would get payment in from others for quote unquote rent, but he never paid any rent out. There were certain things like that. He would get a new car, he would pay it down in a very short amount of time. So just to remember that there's got to be something that comes out of all of this effort. And again, this is not a long, I mean, this is a page and a half on a Word document. So this isn't you writing, a long document and taking up a whole bunch of time. If you have the right stuff, if you're addressing the right threats that this person or that business is presenting to you, then you don't need a lot of words. It doesn't need to be a huge lift, as long as it's effective and it does something at the end other than stays as is. All right, so let's move to the last slide, and then we'll open up for some questions. I see there's several already. So just very quickly, for when you're doing this, you need to identify how you can capitalize really on managing your high-risk customers. You can do an intentional risk expansion, or you can just provide a more accurate view of your current risk exposure. I think that's what most institutions really are lacking. I think a lot of board and executive management are like, let's start making non-interest fee income. And it's like, okay, great, but let me identify our current riskiest customers and how we are managing them. Are we effective in how we're managing them? Fees are huge. So fees, to me, they weed out customers that are only banking at your institution because there are no fees. So if you have customers that do not agree with your fees, then they typically don't grasp their own risk exposure, which means that they're transferring that risk exposure to you. So when you add fees to higher risk customers and the management of them, if they don't like it, great. Then get to walking, go to the next institution, because I have to have the right amount of people, the right talent, the right system in order to manage you. And if you don't see your own risk, then that means that you're transferring all that risk to me, and I'm not willing to take that. So look to exit higher risk customers, make it a matter of risk tolerance. That's where the fees really are great. If you adjust the fees, and I'm not talking, thousands of dollars, but if you adjust the fees based on cash, based on, cash orders, on, wire activity, et cetera, for some of your higher risk cash and wire customers, your users, if you end up assigning fees to those and they have a problem, that's okay. They will exit on their own. But also don't be afraid to exit those simply because you don't have the right people or the right system to manage them. And my favorite thing is the risk form. This is, if management wants to open up the gates on a particular higher risk customer type, if management does not agree with you exiting higher risk customer types that you are not equipped to manage, the risk form allows you to clearly state for them what the risks are, what you're not willing to take on because you don't want to wear orange, but you're not willing to have all that risk transferred to you when you don't have the right authority to make that decision. And that's where that form, it clearly outlines the risk exposure for the decision makers. It shifts the risks from you as the AML officer to the decision maker, and it provides a clear trail of documentation for examiners that the AML officer does not have actual authority. You have the illusion of authority is what I call it, right? You may have a seat at the table, but you don't have a voice. So that's where that form really lays it out very clearly, that you really don't have a say in what your risk tolerance is. And if you need a sample of that form, I'd be happy to send that to you.
I'd like to thank Sarah Beth. She's such a dynamic speaker and we love having her. She led a great discussion today on high-risk customers. This now concludes our presentation, and thank you. Have a great day.